CEO Lloyd Blankfein has a plan to get around the Volcker rule. He has shut down 2 prop trading units already, but Goldman's Special Situations Group is still in business. Why? Well, Goldman says SSG doesn't make bets with the firm's own money, but others say that's exactly what it does. So let's find out what Robert Wosnitzer thinks. Robert is a former Lehman Brothers bond salesman, now at NYU writing his dissertation on prop trading. That makes you an expert, Robert. Let me ask you this question because I know it's one that you've considered. Is there a difference between prop trading and what Goldman would call principal investing?
It's a great question, and I think what this story is pointing our direction to is the point that Goldman is trying to claim that this is a lending business, which is trying to say that they're the old bankers, the old 3-6-3 rule: borrow at 3, lend at 6, get on the golf course by 3 o'clock. And when we start to look at the quality of these investments that they're making in loans, these things are much more different than just your traditional bank loans that they're making. And I think what's going on here is we're seeing the spirit of the Volcker rule, which was to bring some of the sharp edges back into the Glass-Steagall repeal. So what's going on here is you see Goldman starting to use their own capital in very, very interesting ways that, fudges the line between prop trading.
Fudges the line, right. I mean, and it's not just the lending that you talk about, and I guess pushing the edge of lending is what some people would call loan to own or loan to control, which doesn't sound like a typical bank loan to me. And the other side of it is that some of these investments, let's call it, aren't actually loans in the sense I'm giving you money. It's I'm buying your debt on the secondary market, which doesn't sound a whole lot like supporting corporate America and the spirit of the Dodd-Frank Act to me.
I would tend to agree with you, and I think that the article does as well. And I think, let's remember, as I teach some of the students at NYU, a bond really itself is nothing more than a loan that's available on the secondary market. So again, when we start
buying and selling loans are a whole lot different from making loans, right?
Absolutely, absolutely. Because and then when you start to see, and I think some of the commentators in the article have it right, who are the people running this group? I mean, these are former traders. What are their skill set, the people buying these loans? These aren't bankers in an office making credit quality decisions. They're really making decisions not only on the credit quality of the loan, but also profit potential, also marketability, a whole other series of questions.
Robert, the last time you were here, we talked about the very difficult definitional difference between prop trading and market making. That's much more on the trading side, where you can put capital at risk on behalf of a client. If you end up with a position and you hold it for a while, is that a prop trade or not? You can really see where regulators might get stuck on that one. How about this one? Do you think this is much more of a looks like a duck, talks like a duck, walks like a duck, thus it is a duck to the SEC and to the Fed and to the other bank regulators? Well,
it's hard to say. Again, I think Goldman, by claiming this is a lending business, is certainly making a claim that this is not traditional proprietary trading. Yes, it's capital, but we're making loans. Now, I would agree with you. I think that regulators should be able to see this quite easily and say, well, they're using loans, and they're using loans in a very different way than what a bank would use them.
What if they said, okay, you can lend money under whatever circumstances you like, but you can't make secondary market trades? Do you think that might, again, we're talking about proposals here and principles, might that be an acceptable compromise?
It could and it couldn't. I think it's, again, so difficult to say because it's not just isolated to the loan itself. We also have to think, I think in the story that you're talking about here, there was an instance where one of the lendees started to get into trouble and they had to go public, and a whole other series of moves begin to happen when an investment bank is making loans versus a traditional commercial bank. And I think we start to run into the consequences of what these loans can do that is very different from when a traditional bank is just making a loan to a corporation.
What would Paul Volcker say?
It's a great question. I think Chairman Volcker would probably say there is a difference between banking and investment banking, and we need to make those lines much more clear. And I think Goldman Sachs, being an investment bank and then getting into more commercial bank lines, starts to get between the two. And so I think he would call for a much more stronger division between the two. And
Robert, thanks so much for being here. Robert Wosnitzer, he's a former Lehman Brothers corporate bond salesman, now studying prop trading at NYU. And